Hello, can you hear me, Thomas? Can you hear me?
Yes, I can.
Cool, cool, cool. Thank you for coming. I'm quite excited that you came because I tried to write this up with your question about like how to create a watch list.
Mhm.
So I really hope that I'm able to provide some insights, and I'm going to kind of talk for about like 15 minutes, 20 minutes,
Okay.
more or less. I'm going to break down into 4 parts what I'm going to talk about. And then I'm going to give you plenty of time to kind of ask questions. And at the end, I'll say to you, oh, Tomas, is there any other things that you kind of would like to talk about?
Okay.
Because sometimes things surface and you're kind of at the back of your mind and you kind of go away and you kind of think about it afterwards and it comes to it. Okay. So first things first. I'll just give it another couple of seconds for to see if George is going to come because he normally comes, but I didn't hear from him. Just give it another couple of minutes. Okay. I'll just start and then we'll see how it goes.
Okay.
So basically, you know, when it comes to investing, things change in terms of the sentiment a lot quite quickly. So I wrote to you yesterday that like experience and self-confidence and patience are everything that everybody has when the share price is going up. So there's no need for any action or perceived action when share price is going up. The share price is going up and everybody's kind of happy and singing along and there's no problem with that. But that experience and that patience really come under your test when stocks sell off. And I'm not talking about, when stocks kind of are down for 2-3 days, because everyone's kind of like okay with that. When there's kind of those periods that last 2-3 months, and then it's like everything's like, oh, it's new regime. The regime has changed, and it's kind of like people kind of get all disorientated. Okay, so
Okay.
what I think is quite helpful now. I always say this is what I do for my experience, and you take whatever you want from here. It's like a take it or leave it situation. So if it's useful, take it. If it's not useful, don't take it. Now, for me, I track quite a lot of companies, and you don't need to track all the companies that I do, but you do need to be aware that when you're deploying, what you're trying to do when you're investing is you're trying to deploy the capital that you've saved, and you're putting $1 down today in the hope that in 2 years it's worth more than $1. This is really important. So you're trying to keep buying power. So you put down $1 in the hope that in 2 years after inflation, blah, 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 that's worth at least as much as $1 or more. Really, that's what you're working towards. So it's an important decision, and it's one that you shouldn't really just be all kind of willy-nilly. You should be quite focused and put a tiny bit of effort there into doing this. I follow 3 metrics. These are 3 metrics that I use to create my basket. And then I'm going to highlight a specific stock that only because it's right at the front of my mind, because I just literally wrote about it as DraftKings. So just literally wrote about it, so it's kind of fresh on my mind. But I'm looking at really 2 things, and this is like they run in parallel, really. I'm looking at the growth of customer adoption. This is so important for any business, whether it's be a commodity business, whether it be the best NVIDIA, SaaS, AI. Now the new trend is GLP-1. I don't know if you've heard about this one. It's like the new craze. It's this drug. Have you heard about it, this GLP-1?
I've worked 12 years in pharma, so yeah, I've heard a lot about it. I'm really surprised okay, we can have another discussion because for me it's an artificial hype.
Yeah, for sure. But like, it doesn't matter what it is. Doesn't matter. You want to see over a period of time a customer adoption, and you don't need to track these businesses forever. Okay, it's not like I'm saying, oh, track like the business for the next 5 years and see how it feels, but track it for at the minimum, a period of 90 days. You're collating information. You're trying to get, that's the minimum. You need to be tracking this company before you make your investment decision. And why I say it like that, I'm trying to say something that the way that I invest, I'm an inflection investor. So I'm looking for that change in that story. Okay. So the way that I'll describe it is, when I think of a business and everyone thinks that this business is like meh, and I'm looking for that business to no longer be so kind of meh and it kind of being average. So that's change. If I get it at the right point, if this is assuming when things work well. I'll just explain the kind of how things work well, and then we can kind of back away from that. But when things work well, if you get at that point of inflection where you can see that the story on the fundamentals have changed, and the management, you've been tracking the company for at least a quarter, so at least 90 days you've been tracking the company, and then you get the results. The results come in and it reaffirms your thesis. You have a thesis and you kind of look through for me personally, I follow the customer adoption curve and I follow the free cash flow line. I'm going to come to the free cash flow line in just a minute, but you're trying to build this thesis so that when the results come out, you can see, okay, this is what I thought. And I think, and I've said this before, it's so important to write down, because your mind has this ability to trick you. Man, the mind can trick you to forget whatever you don't want, whatever is the inconvenient truth so quickly. So you don't need to write a lot, but we've discussed this before. Just write if I assume that the customer adoption curve is going to grow by 5 or 10%, something in that ballpark, compared to the same period a year ago, what's the number that I'm looking at? Just write it down. Once you've thought it out, it's at the top of your mind, it's a couple of seconds, you look there, it's yes or no. It's quite binary. And, in the ideal scenario, you are trying to be quite conservative, leave yourself ample margin of safety. But really, so that you see what you thought and what it is. So that kind of how it lines up. The second thing that I believe is really, really important is to remember that the market is always looking at least 6 months ahead at the minimum. So it's looking 6 months ahead. Now you want to be thinking a year ahead, so that in 6 months' time, in May, what you're looking out and trying to sniff out, when we come to May, you've already kind of had some view what it should be. Okay, but I don't believe that a person should be in this. How I do as an inflection. I'm trying to look for that inflection. I don't believe a person should be looking out more than a year out. 18 months, a year and a half should be the maximum, because nobody can forecast really very far into the future. You can make a bet on the status quo. That's okay, but that's a very good way of investing, and that's fine. But to be an inflection investor, you're trying to get a narrative change. You're trying to kind of get in there. And if you're right, so you need two things here. The first thing is, the way I do it, is I'm trying to build into my watch list 2 catalysts. Number one catalyst that I'm looking at is the increase in free cash flow. This is really what is important to me. And the second one, I want a margin of safety in that customer adoption. Okay? Now, number 3, and this distracts and confuses people a lot. Valuation is important, but it's not where you should start. You should not start there. Any business, you should not start there, because valuations change quite a lot. In one period when interest rates are 0, paying, let's say, 20 times earnings can be okay. in another period when interest rates are close to 5, paying anything close to 14 times earnings is like, whoa, 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 like that, you know? So you need to think about the valuation in the last step. But it's very important that you have this kind of quantifiable framework, for me, customer adoption and increasing free cash flow, so that you can be really able to be quite succinct in what you're looking for. Now, a lot of people like to buy stocks that are down in price, and they often say, oh, you know, I bought a stock at, let's say, at $40 and now it's $10 and it's down like 75%, and therefore it's a bargain. No, like, it doesn't matter like what the share price was. That never matters. You always have to think about two things. You always have to think about what the share price will be, and this is where things get quite contentious, is that value investors always think, from the Ben Graham school of thought, that it's always great to get a really cheap stock. But that strategy worked so well for so long that nowadays what is cheap, Ben Graham would have considered quite expensive. So things that we say, oh, this is cheap, it's only, let's say, 6 times earnings, he would have said that like, whoa, that's crazy, because he's paying things less than 1 times earnings. But that strategy works so well that nowadays it's been arbitraged away. And things that are really, really cheap can always get cheaper. So it's important to go back to that framework that I believe is, you track the business for at least 90 days. You build that little model for yourself, just a couple of words. I think that's really, really helpful. I don't think that a person needs to be too, you know, I've said this before, but in investing, we kind of have this idea that it's like easy to overcomplicate, you know, like you kind of have that background as well. I think that it's like, it's so easy to make things more complicated than it needs to be, because it makes us sound smart, and we're kind of like, oh yeah, but like what we're trying to do is, you know, I'm not a very good player, but I play a lot of chess. But that's where I go to try and kind of satisfy my ego. I'm like, oh, you know, I'm like, I'm having a good game, and like, oh, I'll crush my opponents. But like in the market, it's different, right? You should try as much as possible not to have any kind of biases, and you should try and come to it without any kind of emotions and make it really simple. I'm looking for this, I'm looking for that. And you try not to squeeze the business into that framework. Be quite selective in when you kind of buy a stock, so that you're not going to make many investments. And the thing that I've often found is that when the market is doing quite well, people.
I'm losing you.
Sorry, wait, can you hear me? Can you hear me? Can you hear me? Hold on. Hello, can you hear me?
It's on my side or yours. Okay, now
side,
you waved your hand, but
yeah.
I've been seeing it as something like 5 frames per second. So
Okay, can you hear me though? Can you hear me?
okay, wait a second. I will stop my video for a second. Now I see you better.
Okay, it shows a little yellow on your side. It might be your side.
Okay, continue.
Okay, so basically, when the market is going really high, people have a more of an inclination to start investing. Oh, let's put money to work. I've seen this. I've seen this so many times. When the market is going high, people make a lot of investments, and that's why I always say, just space out the investments, because the market can trick you into convincing that now is a good time to get in. And you know, when everyone kind of in unity comes to it and says, oh, you know, now is a good time to get in, the market has a tendency to kind of take a breather. And it's really important to remember that stocks never ever go up in a straight line. Even the best stock in the world never goes up in a straight line. It's always kind of up, back, up, back. So it's really important to try and space out allocations to the portfolio. Even if you, for example, don't have any extra aside from what are already invested, don't do too many buy and sell decisions in a short period of time. Try and space it out. Does that make sense?
Yep, that's what I'm. Okay, perhaps I can tell you later, because I'm doing lots of decisions every day, but these are minor decisions. So I'm not changing 5 or 10% of my equity each week, but rather than, 0.3 each day, sometimes if
Yeah.
needed.
Yeah, okay. I feel
So,
that, yeah. As I said,
but that's, a personal style. It kind of corresponds to what you said in a way that I'm not building or selling my position day over day. I prefer minor changes each day that sum up to major changes, but over a longer period of time.
yeah, it's a person often feels that they are more in control of the investment by making all these kind of decisions. But I found that what really, and everyone says this, but what really works is to work on the assumption of trying to be patient, and it's like it's really difficult. It's like when you're having a kid, it's kind of the work that you put in. You just have to be so incredibly patient, and even if it feels like it's just so unjust that it shouldn't be like this, and they do something and it's like and you go mental, and you have that you feel like when you're kind of making all these decisions, like you kind of you having control of stuff. But I find that what actually works out better is, this is again my opinion, is not doing anything for, let's say, periods of, let's say, 2-3 months. But that's just my way again. Anyway, I'll just kind of move on. So the other thing that I'm thinking about when I'm thinking about a third criteria, which is about talking about the valuation, I'm really thinking about not so much directly the valuation, rather the expectations that people have. It's a subtle difference, but it's really, really important, because you compare the valuation of the company that you own relative to its peer group. I don't believe, as I used to believe, that just because something is cheap relative to its peers, that it's a better investment. It can be. That's like the reason why I selected Palo Alto, is because I felt, okay, I can stomach that aspect of it, that it doesn't have as much of the cybersecurity panache as its peers, but at the same time, it's doing the right things, even if the whole portfolio, what they're doing, is not all in this kind of next generation security. There's enough of that I'm getting exposure to this growing trend of cybersecurity demand, but I'm not paying a very high premium. The same what I did with Broadcom. When I kind of invested in Broadcom, I was like, I can understand that AI is going to be massive, 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 but I didn't want to buy NVIDIA. So, and like NVIDIA may work out really, really well, but the expectation is so high that it's not enough to kind of recognize the best company. You have to recognize where there's that mismatch between what people's expectations are and underlying reality. We can all like build stories in hindsight and say, oh, like NVIDIA would have been a great investment.
I'm stopping the video because I've been losing you for a second. Okay.
Okay. I think are you still there? Are you there? I think your connection is quite bad.
I'm there.
You're there. Okay, fine. I can see now it says red under your name. So mine shows okay, but yours, it's gone white. Okay, we're good. I think you can hear me now. I think you can hear me.
Wait a second, I will do something different. I will disconnect other devices from the network, so perhaps. But continue, I can hear you right now. So
basically, I just kind of wanted to just wrap up here. Like, I wanted to say that the most important thing of all this that I'm discussing when you're building your watch list, the most important thing is a strategy that is repeatable. So I have put it down to these 3 things for myself: the customer adoption curve, the increasing free cash flow, and investors' expectations. But you need a strategy that is repeatable. That's really the key, because you want to try and become a better investor with time. You want to try and grow as an investor. You want to be able to recognize, okay, that is a good investment to make. And then you want to, when you do it, you can track the progress because you've written those couple of bullet points for yourself. Okay, I'm buying, here's a date, my thoughts, and this and that. And you just build this little track record for yourself so that you can become a better investor. This is what I think is quite important when it comes to building the watch list for yourself. Yeah, that's pretty much all I had for today. I'm happy to kind of discuss ideas and kind of just go backwards and forwards.
Okay, so one, I think, additional question, because you are very consistent with your investment strategy, so everything, so to say, makes sense. How do you generate ideas for your watch list?
Yeah.
So we've discussed what to do when you have your watch list, when to move on from watch list to portfolio, but the idea generation phase, I'm interested.
Yeah, this is where the real hard work comes. So everything I've said to you is just like the icing of the cake. This is where, you know, the grind comes in. I work countless hours and I'm just tracking everything. So I'm looking for, like, I just track so many companies, and it's not that I do a little screener or something like that. No, I don't do any of that. I literally just go for company after company. And sometimes, man, it's, you know, the funny thing is, sometimes I'm writing something and I make, like, I don't think anything about it. Okay, I just kind of like, oh, right, blah, blah. I just dump it, publish it. And then I'll come back like 3 months later, it's like, and I always go back and I always read what I wrote. I was like, this is what I was thinking. And then I kind of say, oh, okay, so this is what I was right, this is where I was wrong. And I build that little track record and I say, you know what? Hypothetically, okay, like, and I was following CrowdStrike for quite a while before I kind of recommended Palo Alto, but I was kind of understanding the need for this cybersecurity. I was kind of like, I was doing the work on this company, and it never came to anything with that company, but it built a database in my mind to see that there was another potential there. So, and I know I'm kind of trumping my own horn here, but the same thought process kept me out of Sentinel-1. And at the time, there were so many people writing to me that I misunderstood things, and the Sentinel-1 was like going to take over Amazon and all kinds of stuff people were saying. People like, they get in their minds, they get in a state of fever, you know, particularly when share prices are going up, they everywhere, like the media, everything, everyone gets kind of a bit dislocated. But by following like company, like in this case, CrowdStrike company A, I was able to understand that I didn't want to be in company B, but company C was the one that in this case, Palo Alto Networks. Now, obviously, I'm telling you a story that where like the company that you know, and I'm like highlighting something that obviously worked out. But I've also kind of recognized where the story changes and I need to get out as well. That's really, really important. A long time ago, I was invested in Farfetch, and I could see the things were really unfolding for the negative side. So that, again, that inflection to be able to, okay, the investment's going to work out, to it's not working out and it's only getting worse. So don't want to just kind of say when things are working out positively. I also want to say that, you know, it's important to grow as an investor. You grow as an investor by two things. First, keep a track record. Really, like, this is like fundamental. You keep a track record, and B, you try to be really honest with yourself, because you're the easiest person to trick. So yeah, I think that that's like, basically, I don't use a screener. Just a short answer. I don't use a screener.
You don't use a screener, yeah?
No. But also having, you know, like, some curiosity. I think you read a lot, you know, having some curiosity in the world and kind of, yeah.
Yeah, that's what I wanted to say because I'm trying this out right now. I think it was an advice by Buffett and Munger as well. Just spend some time a day reading, just reading newspaper, reading news, and just think what it brings into investing. And perhaps it does not pay an immediate reward, but then in 6 or 9 months time, when you stumble upon a company in a business you've never heard about, you would normally never have heard about, you suddenly, oh, I've read about it, I know something about it. And
I,
it also pays off not just to read the headlines and sexy stories about AI or, as you said, GLP-1, but that's completely different for me. Just to not to doom scroll Facebook, but to read different parts of the newspaper, just see what you can bring out of it, and that's how I found some investments. And about the screeners, it's not that I overuse them, but since I'm see what's in the top, and just out of curiosity, check what the heck it is, because perhaps it's nice, perhaps not.
I find that I personally have not had a good experience with using screeners. I found, but different people, different things. I didn't find it a good use of my time. But going back to the curiosity aspect, there's an insurance company called Markel. They're quite big in the US. And I met Tom Gaynor at an investment conference that he had, and he says, "Oh, I know that Charlie Munger he says don't read fiction books, but reading fiction books has made me more personable, more ability to connect with people, and more ability to understand people. And sometimes there's not a direct line between investing in yourself and investing in your portfolio. Sometimes the world is kind of a bit convoluted, but it does work out. It does really work having this curiosity, not such a rigid framework of like using a screener, but at the same time, as I said to you, have this framework for how you invest. Look for this rigid framework. Whatever the framework that you have can be quite different, but have this rigid framework so that you can make your investment process quite strict and disciplined. Does that make sense?
Yeah, and perhaps if I can elaborate, because when I say using a screener, so for me it would be just 5% of my time. For me, I say it's a low-hanging fruit to see what's in Seeking Alpha top stocks.
Yeah.
To see what's there, to read some of the bull thesis, bear thesis. So I'm not saying that I should obey what the screener says.
Do you subscribe to the quant picks on Seeking Alpha?
I'm just saying that perhaps there is a company I do not know, and someone has already done some. I subscribe to few things on Seeking Alpha, but I think everyone who is in premium has this top picks, which is a combination the highest metrics on quant and all the modified it because I do not believe that or profitability.
When you look at the screener,
enlarge it. Yeah.
Sorry, you go on. Sorry, go on, please. Continue, please.
So I just look at the screener like, number, thinking whether it makes or doesn't make sense, the investment story behind it. So then I go to number 2. Perhaps one thing, because there is always a practical aspect to it, because I'm based in Poland, I cannot invest in all companies listed on stock exchange. So if someone is from the US, he probably can choose 80 out of 80, which are in Seeking Alpha screener. In my case, I already Polish brokerages, and it suddenly narrows down to, let's say, 18. So that's the first and biggest screening for me. And then I just go through it and just say whether it's, nice or wrong. And the second aspect I'm looking at it, I believe that many quant ratings are retrospective, not prospective. So they've already given high marks for the stocks because of what has happened, and not of because what we said, what's going to happen in the next 6 or 12 months. So they, give higher rankings for retrospective, not prospective growth, and so on. So I think there are few checks. And in fact, I'm applying sort of your approach into what I see from the screeners. Of course, it varies a bit, but it's okay. So whether the company is still going to grow or it has just grown and that's why it appeared on the radar. So what's the customer adoption? Whether I'm comfortable with the future cash flows. The fact that it has risen doesn't mean it's going to rise forever. There can be a briefer any time. So, I'm not saying, because many people ask me whether I use screeners or not. Yes, but for me, screener is just, and I elaborate on it rather like, okay, I've used the screener. These are top 5 picks, so I will invest immediately. So most likely out of 20 or 30 companies from the screener in 2 months, I may consider 2 for future investments. So I'm doing screener on the screener on the screener. I don't know if it makes sense or not. So
It makes a lot of sense. Yeah, absolutely. How often would you say that the picks that change on Seeking Alpha?
Depends on the picks. Sometimes some tend to stay for quickly, but there are many things you need to pay attention to, because the basic screener takes into consideration earnings revisions. And my feeling is that there is a month when there is a very positive earning review. There are 2 months where no analyst changes everything, so it suddenly goes down and disappears and reappears again. So I would say you need to know. That's what I love, because part of my curiosity is I read how these picks, how these scores are made, what they consist of. Because of my statistical background, some of the picks are based on analyst estimates. And if there are 2 or 3 analysts covering a stock, I know that it's not a representative sample, so on. So, but perhaps according to me, some picks stay forever in Seeking Alpha, some picks, stay for 7 days and
That's very interesting. Yeah, that's
disappear for unknown reasons.
That's really interesting.
So I have a process, because I just told myself that there is a day each month I will see the top screener with my, that's what I told. I do not need revisions to be top always. I do not need momentum to be top, and I do not need profitability margin to be at the top, especially if you say there is an inflection. So the profitability margin may change.
Yes, for sure.
Then I see what time in a month it may reappear, and then I look at it, But it's more of a curiosity. And with Seeking Alpha picks, I try to be, usually when I see something for an investment and I found really nice, I try to imagine it in 12 months, as you said. And I ask myself if I can see it doubling or at least having 80% in a year time. And whether I would feel comfortable in a year paying this amount for it as fairly valued, not as a bargain or opportunity, as fairly valued.
Yeah.
And I want to sell it much before to have this, ample space of.
Yeah, of course. But the thing that I found is that you need not only the time you buy for the market to be kind of weak, but you need the day you sell for the market to be like strong, because it can be so difficult if the sentiment is not with you to your back. Do you know what I mean? If you buy when the sentiment is very strong and then you kind of sell even 2 years later, but the share price is all down, it can really affect, even though the company is delivering, but the market is not aligned with that strategy.
Yeah, but that's where, because my strategy, I believe I have similar number of stocks in portfolio and concentration, and as you said, and the fact, and I believe that when I have a diversified portfolio, and obviously there will be some failures with market disagreeing with me, regardless of the company performance, in my opinion. But then I want to focus on the ones that perform here. So, and also we are talking about strategy. So my strategy would be that 80% of my portfolio should focus, I would say, more rigid approach. So as I said, I'm imagining the stock in 12 months. I use some screeners and entirely bound by my process, because there may be some flow in my process that would prevent me from, getting some returns. So I also later try, as you said, because there was important thing that you mentioned, that if you keep track of your investments, and I do trick, I'm an Excel fanatic, then I can go and say, okay, I bought it, I believe this to happen, it has or hasn't, and perhaps it hasn't, but it's still skyrocketed. So yeah. Okay. I think that was the third depression in a line.
That's okay. That's okay.
We
Anyway,
were talking about.
I better wrap up here because the connection is just breaking up. While we still can hear each other. Thank you so much for coming. I really appreciate it. And I just want to say, drop me a line anytime, and I'll try and
Okay.
get to it, and it doesn't have to wait a week. I can just write to you. But yeah, thank you so much. Really appreciate it. Okay.
Okay. Thanks.